This episode is about paying yourself from your own company. That means salary, dividends, pensions, and directors' loans. Taking money out of your own company is rarely as simple as choosing between a salary and dividends. The right mix depends on the company's position, your wider income, and getting the paperwork right. This episode compares 5 areas: choosing a director's salary, how dividends are taxed, timing those dividends, employer pension contributions, and directors' loans. We'll take each in turn. Once your company has earned a profit, the next question is how you should take money out. The answer is rarely as simple as pay a tiny salary and take everything else as dividends. For the 2026 to 2027 tax year, the standard personal allowance remains £12,570. Employee national insurance normally begins above £12,570, but employer national insurance starts much earlier, above the £5,000 secondary threshold at a rate of 15%. The lower earnings limit, which can help protect a qualifying year for state pension purposes, is £6,708. That creates several possible salary levels for a director. A salary around £5,000 can avoid employer national insurance, but it may not create a qualifying national insurance year. A salary at or above the lower earnings limit may protect the record but creates some employer national insurance. A salary up to the personal allowance creates a larger corporation tax deduction, but it also creates more employer national insurance unless the company can use the employment allowance. There is no universal best figure. The calculation depends on the company's corporation tax position, other income, pension record, number of employees, and eligibility for employment allowance. A company where the sole director is the only employee liable for employer national insurance cannot normally claim that allowance. Dividends are paid from profits available for distribution after corporation tax. They do not reduce the company's corporation tax bill, and they must be supported by accounts, board approval, and dividend vouchers. The dividend allowance remains £500, but that does not mean this amount disappears from your tax bands. It is taxed at a 0 rate, while still using part of the relevant band. For 2026 to 2027, dividend rates are 10.75% in the basic rate band, 35.75% in the higher rate band, and 39.35% in the additional rate band. Those rates increased from the previous tax year, which is why old videos quoting 8.75 and 33.75% are now out of date. Timing can help. Suppose you are already in the higher rate band this year but expect much lower income after the 6th of April. Delaying a dividend may reduce the rate charged. However, you cannot backdate the paperwork or pretend the dividend arose later. The company must have sufficient distributable profits, and the dividend needs to be properly declared in the tax year in which you want it taxed. Cash flow, benefits, mortgage applications, and other income all need to be considered. Employer pension contributions can be even more effective because the company pays directly into a registered pension scheme rather than paying the money to you first. A qualifying employer contribution is not normally salary and can be deductible for the company where it is incurred wholly and exclusively for the trade. The standard pension annual allowance is £60,000, but it covers contributions from all sources and can be lower for high earners or people who have flexibly accessed a pension. Unused allowance from the previous 3 tax years may sometimes be carried forward. Be careful with simple corporation tax examples. A company with £80,000 of profit is not automatically paying a flat 25% on every extra pound, because marginal relief may apply. The pension saving should be calculated using the company's actual marginal corporation tax rate. A final option applies where you have genuinely lent money to your company. The company can repay the capital without treating it as salary or a dividend. You can also charge a commercial rate of interest under a written loan agreement. The interest is normally a business expense for the company and personal savings income for you. The company must deduct basic rate tax at 20% and account for it using Form CT61, while you report the gross interest on your tax return. Your personal savings allowance may reduce the final tax, but the interest is not automatically tax-free. In the next episode, we will look at involving a spouse or family member and why genuine ownership and genuine work matter more than clever paperwork. For a tailored salary, dividend, and pension calculation, contact ABC Business Services. You can speak directly with a member of our team, email us to arrange an appointment, or visit our website for more information.